Manish Tandon joins us. He's, of course, the MD and CEO at Zensar Tech. Hi, Manish. Good to be speaking with you. Thanks so much for making time and speaking with us. Well, you had a weak Q2, but this is something that you'd already warned us about at the end of Q1 because you had some client-specific issues and higher furloughs. But how would you rate it? Did it pan out as you expected? Was it worse? Was it better?
Oh, I think with all the headwinds that we faced, I think we did a phenomenal job this quarter. I think if you look at, I had already pointed out furloughs. I had already pointed out that there will be some clients who are impacted by the CrowdStrike outage, and both of those things happened. So on the revenue front, we still delivered 1.2% growth, which is better than what I was expecting, to be honest with you. On the margin front, we delivered 15.4% of EBITDA, which is better than 15.2 that we delivered last quarter, and this is despite the fact that this quarter we gave salary hikes to all our employees. And I think the icing on the cake has been our performance on order bookings. We've just had one of the highest order bookings ever in the history of Zensar, and it has crossed 200 million, 201.8 million or something. So overall, I'm very pleased with the performance this quarter, and I was expecting worse, and kudos to the team.
Okay, so Q2 fared out better than what you expected, at least what you had started off with. But do you want to warn us anything about Q3? Are those client-specific issues still persisting? And what about furloughs? Will it continue to be higher than usual in Q3 as well?
There are two uh, good news that I wanted to share. One is the sector that is most impacted by furloughs is the TMT sector. And as I have pointed out today to several people, that if you compare to the last quarter, the same quarter last year, the share of TMT revenues has come down from 27% to 22%. So, which means that even if the furloughs are there, the impact of that on our numbers is going to be less than what it was last time. And the second thing is that some furloughs happened in Q2. So, from a comparative perspective, we now need to worry only about the incremental furloughs and not the full impact of the furloughs. So, I think those two are the positive things. And if the order bookings that we have done, if we can translate into a good conversion of revenues in the current quarter itself, then you know, who knows, we might even show some growth.
Sir, you also talked about a solid order bookings. So how is the pipeline, if you could tell us, and which are those segments that are driving this growth in order booking and the pipeline?
So for us, except for TMT, all the sectors have been performing quite well. Banking and financial services, as this is the seventh consecutive quarter of growth. Manufacturing and consumer services also, this is 6 quarters of growth, if I remember correctly. Healthcare, life sciences, also since we have started it off as a new vertical, we are seeing good growth there. So except for TMT, we are seeing good growth in all of our verticals. So it's more of question of how much further dip do we see in TMT vertical, and will that be compensated by the growth in other areas that we have? Pipeline is, I would say, is good. There is nothing alarming there. I think we are also working on a couple of large deals. Hopefully, some of them will get converted in the next quarter, in this quarter, that is. So, From a commentary perspective, I'm quite happy with where we are today as compared to what I was expecting when we started this quarter.
And sir, how long do you believe this dip in TMT will continue?
I think this quarter definitely there will be a dip because of furloughs. Q3 has never been a strong quarter, so for TMT, so definitely Q3 there will be some dip. But as I've been telling everyone, I mean, this is a sector where a lot of the legacy technology companies are facing a lot of headwinds. They themselves do not know where they are headed and whether they have hit the bottom or not. And I would say that in that kind of a situation, it's very difficult for me to call out that we have reached the bottom or not. But as I said, Q3, I can definitely say that because of furloughs, it will be a weaker quarter for TMT. But whether it will be the bottom, I don't know.
Okay, so can't call the bottom, and a couple of more pressure points as far as the overall TMT segment is concerned. But how's the Bridgeview acquisition scaling up for you so far, and anything else in the pipeline, Manish?
We are very pleased with the Bridgeway acquisition. I think it was a tough acquisition in the sense that the target had to be split into two, and so there was some amount of disruption that we expected and that we saw. Um, but overall, we are very happy with the progress that we are making with Bridgeview. So much so that we will be integrating Bridgeview totally into our healthcare and life sciences business. It will no longer be considered, it will always be considered a part of the overall picture that we will draw for healthcare and life sciences. So that is one, and yes, there are a couple of things on the anvil that we are looking at. We have a couple of non-binding offers out there. Let's see if something materializes.
Okay, so a couple of important deals on the table for you, but any more color you can add? Let's say the size, the geography, the capability you're looking at adding, Manish?
One particular one is in Europe, particularly Eastern Europe, is all I can tell you at this stage. And another one is in the US.
Also, lastly, before we let you go, the margins improved despite a weak top line and wage hike. How much more of a headroom you have here to increase your margins?
As I've said before, also that we are committed to delivering EBITDA margins in the mid-teens, and this business will require some amount of investment. I do want to invest in sales and marketing to a large extent. I also want to invest in capability development for our people and spend some money on large deals for clients. So we will maintain margins in the tight range of mid-teens that we have promised. Anything over, we will try to reinvest to reinvigorate the growth in the business.
Okay, on that one, Manish, we let you go. Thanks so much for making time and speaking with us. But we're not done with the earnings as yet. There are a lot of numbers which have trickled in, starting with Godrej Properties itself, wherein it's a very good revenue show that they've reported this time around, and the net profit has jumped up quite materially, almost 4x versus what we saw last year. But of course, for Godrej Properties, more details come out in the presentations, wherein they talk about the order bookings and the fact as to what the way forward is. The booking value has come in as well for the quarter. That stands close to 5,200 odd crores, which is up only 3% YOY. So that is a bit of a soft number coming in, but do remember this, the overall, the overall base has increased. So 5,200 crore worth of collection, 5,200 worth of bookings. The collection has come in at 4,000 crore rupees, which is a sizable jump of 68% year on year. And the area sold is pretty much stable on a year-on-year basis as far as Godrej Properties is concerned. The other number that has come in is KPIT Tech. Again, a a strong show coming in. The revenue growth has come in at 7.8% on a sequential basis. However, the profitability is a smidge, flattish of sorts. So that might be a bit of a disappointment. EBIT margin, the management has been guiding that they are looking at redeploying it in investments. So that's why perhaps there's a bit of a pressure there, and the fact that overall wage hike impact seems to be coming in is something that might be impacting KPIT's numbers. The more important thing is whether they maintain their guidance or change it or not, because the last couple of quarters they did look at changing their guidance. So whether they're maintaining it or they're looking at doing better than that is something that the street will watch out for. I'm just going through some expectations. On the revenue front, the company has done better than expectation. However, the EBIT margin that the street was watching out for was 17%. So on the margin front, there is a bit of a disappointment. Even though profitability is in line with expectation, I think it's just the margin weakness. We'll have to wait by and get more details as far as the guidance is concerned going forward. With that, we'll slip into very short.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.